Good evening and welcome to the show. Financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FITT Show. Financial information for today and tomorrow. Welcome everybody around the country and around the world to another interesting show about financial facts and financial information. Hoping it will help raise your boats higher and that you be able to enter into the financial mainstream of your particular area. This is a great opportunity, so we take it. We really appreciate people that get on because we know your time is valuable, but is information. So last week our show was, "Do you need a financial advisor?" And we hope we helped you with that, with asking some questions to yourself of what to look for when you go to talk to a financial advisor. But this week the title is "Don't Miss the Bull." Now a lot of people were saying to me, "Bob, what in the world? You talking bull crap, bull? What are you talking about?" We're talking about the bull market, basically what we're talking about. And it's been, the stock market, as you can see, has been rolling. And we're going to start off talking about the stock market as we always do at top of. But first, I want to make sure, excuse me, please make sure that you go out there and click on the like button and the heart button and even put comments into the comment box so that we can know. It's our way to interact with you, basically, that comment box. And if you have any opinions on what we're saying, comments, or if you have some ideas of other topics you'd like for us to talk about in the future, please feel free to put in that box. It's very important that you put comments in the box because that gives us even more access to more people. That's how the algorithms work with Facebook. Make sure you
Yeah.
share Facebook Live, and you actually make sure you subscribe if you're on YouTube to our channel, and tell your folks to do that too. Really appreciate that. So, Doug,
Hey,
with
Bob,
that, yeah,
before we get into that, I want to go back to a question we had last week about leased cars. And I just wanted to mention, I don't know if I got into much detail about it, but when car manufacturers have incentives to sell cars, sometimes they'll push the incentive toward purchases to lower prices. Sometimes they'll push them toward interest rates. And sometimes they push very favorable lease rates. And if anybody's interested in leasing, if you go to Edmunds.com, they have an article about the 10 best lease deals that are going on right now. Because it's not as simple as would you lease a car, would you buy a car? It depends on the incentives involved, and you should always be able to get back to the purchase price of when you buy. And so in that list, that Edmunds.com has, they just list some of the attractive lease rates that are being offered by certain manufacturers. So as I said before, you really have to do your homework and find out what the purchase price is, what kind of incentives they're giving on the lease. And it may be for you, depending on your situation. I just wanted to mention that. And another scam that I've heard about before we get going, I wanted to mention, and that's with your medical. Make sure you review your explanation of benefits that you get each time you use a medical or use your Medicare or your health insurance, just to make sure nobody's gotten a hold of your medical information and is using your medical information. So check those to make sure that they indeed apply to you. But that's one that seems to be picking up steam right now, is people stealing people's medical information. So just wanted to mention
I
those two.
just want to backtrack for a minute because you stated a site, Edmunds.com,
Yeah.
which is a great car site, even better than Kelly Blue Book. But I want to get, because a lot of people get confused with that. It's spelled Edmunds. It's Edmunds, not with a O. Just want to make sure and go out there, y'all. It's really good site.
I use that site all the time. You can go out there, you can value your trade. They tell you what you should pay for a price based on what prices are out there right now. And like, for example, you may go look at a Honda Accord and its MSRP may be like 35,000, but it may say that the average price being paid right now in your particular area is 33,000. And again, that's information you can use when you go to the dealer to negotiate your price for your car. And we'll talk about this later when we talk about car buying, but if you aren't ready to negotiate, you're going to give up some money when you go buy a car. If you're ready to negotiate, you pick the right time to go buy a car, you should be able to get yourself a good deal. But Edmunds.com is great. It gives reviews on each cars. It'll tell you what features the cars have. It'll tell you every incentive that the particular car manufacturer is offering. It'll tell you cars in that car's competitors. You can actually list them side by side and compare the operations, the size, the speed, the trunk capacity, any metric on a car. Edmunds will have that information. It'll have their reviews of how they feel about the car from their test drives. It's a wonderful site. I use it all the time. And they do have an area that talks about great lease deals. So those of you who are interested in leasing.
And that's the correct spelling on the screen for everybody. It's a very useful site. So with that, let me go here for a minute, ladies and gentlemen. Lee, I wanted to get that off there. Okay, cool. All right, dope. Let's go how we start this show off with one of those important topics that people like to know, which lets us know where our country is going, is the stock market.
Yeah, this has been a very, very wild ride.
You've been giving us some good news the past few weeks, though.
It's been a crazy ride. And if you look, the Dow is for all intents and purposes pretty flat. It's changed by 0.5%. NASDAQ's up about 1%. Microsoft slipped a little bit, but all the techs kind of slipped when it was again noted that the Fed weren't going to raise interest rates anytime soon. Tesla took a pretty big jump, a pretty big drop. And they're having issues primarily in China. The biggest EV maker in China brought out a bunch of new models and cut prices. So there's like a price war going on right now with EVs. And as we talked about before, all those big manufacturers who invested in electric vehicles are finding the demand isn't meeting the supply. So a lot of these EV car companies have a lot of cars on the lot right now. So if you're interested in buying an electric vehicle, you should be able to get a very, very good price. And Tesla stock is reflective of that. The fact that the prices are going to be going down, a lot of price wars going on. Apple's kind of slipping also. Their share in China is going down. They're fighting the governments in the EU. So there's some things drawing Apple down. Pfizer's staying pretty flat. They just got an approval on a drug for use for kids. So that may help them a little bit. And my favorite stock, NVIDIA, continues to grow. It was up another 17% just this week. This one has been going like crazy. Now remember, I bought this stock for 170, and now it's up to 927. So I made a little bit of money on that one. The next one is Google. I bought some more Google. This stock, you can see last week it was 139. I jumped in at 132. So now I got a couple hundred shares of Google, and it's already up 3 points since I bought it. And I got in there Monday or Tuesday, I believe. And I'm expecting that to do well in the long haul. That's another stock I expect to hold. So all in all, the Fed had the chairman put out some talk that, yeah, they do plan on cutting interest rates later this year. Not sure when that's going to happen. But there's still going to be a lot of ups and downs. And as we always tell you, You invest for the long haul. You try to pick good companies. You look for opportunities to get in. That's why I jumped in with Google when it kind of fell back a little bit. I'm not going to buy any more Nvidia. It's too pricey for me right now. I got way too much Microsoft. I'm not going to buy any more of that. Tesla and Apple kind of have me scared right now, so I'm kind of going to stay put where I am. But I'm pretty happy where I am. I'm doing okay, and life's good right now on the stock front.
Yeah, no, and although I missed the NVIDIA semiconductor stock, which is, as y'all can see, every time Doe talk about it's up. Like today, I think it's up like $39, Doe.
It was up a bunch today.
Yeah, it's up, yeah, $39. But I am in a semiconductor stock in XP, which is in all the cars, and you know, Shanghai is using it to do a whole smart grid city, and it's in a lot of things, and that is doing well, though. That's at $259 a share. I got in at $90 a share, and it doesn't move as greatly as NVIDIA, but as NVIDIA moves, so does it, and I'm glad for that. And GE, though, my GE stock is starting to roll. GE is go ahead.
Let's just take a minute too and talk about Bob and I. We always go back and forth about when to sell, and again, we're not telling anybody what to do. We're just kind of telling you what we do, and hope you'll do your own research and make your own decisions. But as far as NVIDIA, I'm up 5 times over what I paid for the stock, and the first thought might be, well, why wouldn't you sell? And a couple of reasons. One, I'm sitting on a pretty healthy gain on this stock, and don't really want to pay taxes on it. Want to just kind of see how it plays out. But the more important reason is, if I did sell, what would I buy? And if I went through everything that I would consider to buy, NVIDIA would be the stock I would buy. So it doesn't make sense for me to sell right now. And that's a decision you always have to make when you own a stock, whether it's going up or going down. You got to make a decision of when to get out or how long you're going to stay in. And I'm pretty much in NVIDIA for the long haul. And if I had something else I wanted to buy or something else that was attractive, I would consider selling it. But as it stands right now, I paid $17,000 for it. It's worth $92,000 now. And so not going to sell. I'm going to let it ride and hope it continues to go up. But again, I think it's a good company, and I just don't have a reason to sell right now.
Right. So, yeah, and so, you know, all our stocks are doing well. It goes to our point that, you know, it's all about the long play. And like I said, though, that GE stock, but GE is going to do something. See, GE, reason why I was in earlier, like years ago, is because they had a finance company, financed automobiles and homes, and they had, you know, call those aircraft carriers.
Yeah, they're in the space world, yeah.
And they had trucking. There were so many industries. I was like, wow, this is the way to be, and something that's diverse. But then they sold off the finance, and their stocks dropped. But now they get rid of the split from the aircraft, not the aircrafts, and medical, because right now they both together in one company. They're ready to get off, and they're going to let people choose which stock they want to stick with, the medical side or the call them it's not combustion engines, it's aircraft engines, right? But gold, man, and you know, I always talk about commodities, especially gold and silver. You know, there's other ones that do really good too, which is palladium and platinum. But you know, I've always been on the gold thing, and remember, I was saying, oh, gold is up to 2,000, and you know, I got in it very low when it was about, like, you know, probably about $1,000, $1,000. And now it's up 2,100 and what is it? Some odd dollars, 2,167. So that works. And silver, I got in at $16 an ounce, and it was up to $24 an ounce. So for those of you who have a, you know, portfolio that's pretty solid, and you know, you may be looking for other things to be interested in. I mean, I'm not saying it's for everybody, but I'm just saying I only got it because to try to balance out what I already had. and it's doing well. That's the point I just wanted to make. Not trying to encourage you to do it.
Hey, Bob, did you buy any gold bars from Costco? Costco sells gold bars, and those things go like hotcakes.
Wait. Costco sell gold bars. I thought gold bars were illegal to sell.
Costco sells gold bars, and that's one of their top sellers. They've sold millions, hundreds of millions of dollars of gold bars.
They must have started letting people do that again, because they were banning people owning gold bars. Because actually,
they definitely sell gold. But the tricky part is that's a price that varies all the time. But when you buy it from Costco, you don't get that. You may end up buying it, and it may not be at the market price at that particular time. But obviously, people don't care, because whenever they have it available, it sells out very, very quickly. And the thing
and you saying actual gold bars, not the gold bars with the chocolate.
Literal gold bars, the physical gold bar. Costco sells them.
Wow.
Costco sells everything, baskets to gold bars. But you got to be
cool.
You got to be careful when you buy it, again, because again, if the price changes up or down, you don't really control that like you do if you buy it from a broker, because you can say, I want to buy it at this price. With Costco, you have to buy it at their price, and their price isn't updated as often as the true price is. So just be careful if you decide to buy a gold bar from Costco. But yeah, they sell a bunch of them.
Wow, that's interesting, man. And I'm looking at it right now. That's whoa, ooh, that's interesting how they selling them.
Yeah,
I see what they're doing, dope. Dope. I knew it was something to this, because I'm like, America does not allow you to buy. You cannot buy a full. They sell gold bars, but they in denominations of less than an ounce, something like that. I forgot how much a gold bar is worth, though. So they selling gold bars, but they're smaller denomination. But a full gold bar, that's what I'm noticing. Because it's like $94.31. That's like a gram, but they're in gold bars. So they playing like the term gold bars. But
no, it is a physical piece of gold. I mean, you're buying a physical piece of gold.
No, it is. No, it's no question. No, it's no question. But I'm saying they make gold bars like a certain amount of grams, not a full. I forgot, the United States, you can't buy a full gold bar it's over an ounce. And I don't think they're selling it for an ounce like this. They selling a kilo bar. I don't know what a kilo bar is, but they selling it. You right? God damn, they selling gold bars.
Yeah, I thought about buying some, and when I did, it was they were out of them.
But they charge more. I see they charge more too, though.
Well, no, again, the price fluctuates, and the thing about Costco, and that's why I love that store, is they only make about 8% on everything they sell. They do not have big markups on anything.
Wow.
That is their company philosophy. They want to make 8% consistently and constantly. So their whole game is to sell high quality products at a reasonable price. You wouldn't guess what their top selling product is. Take a guess. Any idea?
Vitamins?
No. I'm talking gazillion dollars.
What?
It's jewelry. That's their highest selling item. If you get into buying diamonds and you start looking at the color, the clarity, the cut, and all that stuff, they sell very high quality stuff. And again, at a reasonable price. Most jewelry is marked up tremendously, but you can go to Costco, get high quality stuff, and if anything you buy at Costco is not going to be a crazy markup. That's why I like that store. But same with the gold bar. So they're not going to gouge you on anything.
No, you once again, and like me, because I remember the United States, they had banned selling gold bars. People couldn't hold them. You could hold them like at the asset place, but it wasn't people physically. But evidently, it's off, because they definitely selling gold bars.
You can have it in your house. Oh, no
Yeah,
question.
yeah. And
I would
let me
never steer
tell.
you wrong, my brother.
Yeah, no, I know you wouldn't. I know you wouldn't. But that's why I looked it up because, like, I did know that they definitely advanced.
You
There's
didn't
no
believe
question.
me, huh?
No, I always believe you,
I'm
but
just
you know
joking.
me. I come from the finance and a little bit of accounting. Trust but verify. Even my boy. So let's go to the cryptocurrency. Dope. We want to talk about just rolling. Let's talk about cryptocurrency. Look. It was down to 1 trillion, 1.5 probably trillion in the market cap for all cryptocurrency. Now it's back up to 2.6 trillion dollars, up 285 billion, 12% for the market cap. And look at the Bitcoin. The Bitcoin is selling for $66,869. That's $5,689 from last week, up 9%. So
It's
for
crazy,
all
Bob.
my,
This is
that's
just
crazy.
bizarre. Yeah. I
That's
put
crazy.
5 grand in crypto. It's worth $20,000 now. You know,
Wow.
crazy, crazy.
So you mind me asking how much you put in?
5,000. I put 5,000,
And
but
it's
it's
up to
worth
20.
20. Yep, I'm up 4 times.
Right. I put in 3 and I'm up 4 times.
Yeah, it's again. This is another asset that's not for everybody. I only did it. I think I've told you this a couple of times because I think eventually it's going to be the way you do business. But it is so speculative. It could be worth zero tomorrow,
Right.
and there's no real backing like a company with sales and things of that sort. And so it's extremely risky, extremely speculative, and that's why I didn't put much money in it. But I didn't want to get left out, FOMO, and so I threw a little bit of money in it, and it's done okay.
And look at Ethereum, the smart contract cryptocurrency, up $509 a
Yeah.
Ethereum cryptocurrency, 16%. So, I have a lot of people, though, who, and especially people in the financial advising, financial planning, who are very conservative. And they were like, nah, no way. But it's good gracious, it's rolling, y'all. I mean, we not encourage you to go out there because it's not for weak at heart. Because tomorrow that thing could be down to zero, right?
Yeah.
But it's amazing. That's all I know. So let's get into our.
But one more thing before we get going, and I know I'm old, so I forget stuff. But American Express had a data breach. So somebody got a hold to their records and they got account numbers, they got expiration dates. I don't remember if they got the CVS number. So if you own an Amex card, make sure you get alerts of when your card is used. Okay? You can set your alert up to let you know anytime more than $1 is spent because that information is out there and people are going to try to use it. And you just don't want to get into having to ask American Express to give you your money back. In most cases, they will, but you just don't want to get into that. So make sure you got alerts set up. Make sure you're tracking your balance to make sure there's nothing going on. They'll probably put a letter out and they'll give you some sort of monitoring service for free for X number of years. I already have two free monitoring services from data breaches from different companies. And so they're becoming much more common. And it's very important for you to make sure you have alerts for all of your credit cards, but particularly for American Express right now, because they just reported a big data breach yesterday. So,
And though that's become because now I have 2 major credit company alerts that's paying to give me alerts and keep track of alerts, and that's TransUnion and Experian. Because I forgot who was breached with. I forgot who was breached with TransUnion. Oh, I know it was breached TransUnion. It's called Mr. Cooper. Mr. Cooper. It's a mortgage company, by the way, and they got breached, so they gave the free service. Seems like that's happening more and more often. By the way, my sister Nora wanted to know. She said, how much are they selling gold bars at Costco? They selling gold bars as of today, looking on the site, $2,232 a gold bar. Now, as of today, the gold,
that's an ounce, right?
That's an ounce. Excuse me, that's an
Yeah.
ounce.
Yeah.
And today, gold closed at $2,166 an ounce. So
yeah, we're gonna do a show on buying gold. We're going to do a show.
and not just like gold or silver and a couple of more.
It's the same process, but we're going to do a show for
It is
buying commodities.
And it's a commodity. That's the main thing. You're right, though. And you're right. We think we're good because if you have a balanced portfolio, it's not bad to kind of think about. It's called alternative investments. That's what they call, commodities and stuff. And if you have a balanced as it is, then it might not be bad. Right. So anyway, so don't. That very great conversation because the market is rolling, and so it really leads us into our topic for today. What are we talking about? Don't miss the bull, Doug.
Yeah, right now, man, everybody is ecstatic. The market is going great. Everybody's happy, I guess. But Donald Trump, he keeps hoping it'll crash so he can save everything. But the Dow is S&P setting records, NASDAQ setting records. Everything is going good. My NVIDIA has been rolling as we've talked about. So all the indexes are doing well. Bitcoin is going crazy. Everybody's making money right now. And so if you got a good financial advisor, if you have a financial advisor and he's good, he's going to tell you that everything doesn't always go up. Right now, things are happy. And a lot of people who haven't invested might be considering investing now because of everything going up. And that's one of the things I told you about Warren Buffett. He says the best time to invest is when things are going down, and the best time to get out is when things are going up. But
right, it's usually the philosophy.
Yeah, if you got a good advisor, he's going to tell you, hey, yeah, things are going great, but the market just doesn't continue to go up. But if you aren't invested, this is as good a time as any to get in. We're going to talk about not playing the market. We do not believe in timing the market because we think that's almost impossible to do. But investing on a consistent, constant method is what we believe in for the long haul, all the way through, whether it's good times or bad times. If times are good, you're buying lower number of shares. If times are bad, you're buying more shares. So we believe in that. But right now, with the market going crazy, everybody's happening. We don't want you to be missing out on this. And so it looks like, again, I'm no predictor, but it looks like things are going to continue to go well. And we talked about this in one of our other shows of how the market always goes up after there's been a big dip or a recession. And right now, all the indicators look like things are going to continue to go up for a while.
Now, Don, I do understand that most people fear bear markets, because bear markets what? It's when the markets are going down. But investing in the bull market can also prove challenging. As prices rise, investors are aware that surges in the value could possibly last forever. Can't possibly last forever. And it can be equally as challenging to predict when a bull market will end as when it will begin. No one could tell, and that's what me and Doe talk about all the time. Even the greatest economists and financial advisors don't really know. They just always are just speculating based on past information. Those saying there, past returns no indicator of future performance. Now, learning more about the overall bull market definition and planning what stocks to buy in a bull market before it arrives can help put you in a much better position. And you can take advantage of some of the favorable movements in the market. Now, let me give you a fact. Check this fact out, though. The longest bull market in the history of the Standard & Poor's 500 index lasted, check this out, from March of 2009, this is in our time, to February of 2020. And saw the index gain over 300%. So a bunch of you people who are on this, who had their money in the 401k plans, I'm sure that a bunch of y'all benefited from that the longest bull market in history, from March 2009 to February 2020. And obviously, that's right at the pandemic. Now, this bull market was characterized by strong earnings growth. And remember, the Federal Reserve was keeping interest rates low, and it was investor optimism. Now, despite its length, the bull market was relatively very volatile, with several corrections and pullbacks along the way. And the tech sector outperformed the broader markets, just like it's doing today in 2024. So, let's get into it, and let's see if we can give some pearls of wisdom on dealing with the bull market, which a lot of people sometimes think they missed out.
Okay, well, let's start with the basics. What is a bull market? And if you look at the definition, it just describes a sustained positive economic movement within either a sector or in the overall economy. So if you want to identify using technical indicators, you'll look for an asset class or individual companies or the overall market that has risen more than 20% in value over a couple of months. So more generally, it just indicates that it's an asset or class of assets or the whole market is rising in value consistently over time. And so when we talk about stocks, it's usually applied to the stock market in general, or it could be an individual class, just like the NASDAQ has been in a bull market for a while, or tech stocks have been in a bull market. And so it's common for gold. Gold could be going down in value while the market's in a bull market, or vice versa. The market could be going down, but gold could be in a bull market and going up 20% within a couple of months. So you got all this going on. So deciding what you should be doing given this bull market, or even making decisions about what you have during the bull market, can be really challenging. And so you're looking at this 20% increase in value within a couple of months. And that usually gets everybody excited, and there's going to be corrections. And so there's still a few things you can do to try to optimize what you have or what you can make during this market. And for new investors, it's very important that you learn about what a bull market is and get some ideas of what you should be doing in a bull market.
Let's see how things play out after the President's State of the Union address tonight. Raising taxes on businesses. Very good point. I'm really curious, Goldstein, on how his speech tonight is going to affect the stock market. Because in the past, they used to say, one event or speech could really move the market. But nowadays, they don't even know, man. They might say one thing and topple the whole market, or one whole thing and increase the market. So you're right, Goldstein. I'm kind of curious too. What I want to talk about is understanding the bull markets, right? Now, while you might understand the basic bull market meaning, understanding what causes bull markets can be even more difficult. Now, bull markets usually come about through financial, psychological factors. Notice that key, psychological factors, what they call consumer sentiment. They actually have graphs and measurements that really they key on that kind of consumer sentiment, which work together to create and sustain positive movements. Now, bull markets are characterized by optimism, investor confidence, and expectations that strong results continue for an extended period of time. Now, it's difficult to predict consistently, these trends, because they change, right? And a strong growing economy is a fundamental driver for a bull market. When the economy expands like it has, corporate profits rise as they have, it creates a positive backdrop for investors. Now, during these period, consumer spending may also be higher as unemployment tends to be lower. Check that out. Unemployment is actually unemployment is actually lowering. Yeah, it tends to be lower. And check it out. This is proven factually because the market has been really growing. Now, economic growth often translates into higher corporate earnings, which in can increase stock prices. But believe it or not, though, that's one of the key things and what Modestine is talking about. President Biden is talking tonight about how corporations are gouging people, with the prices, and he wants to cap some of the fees and stuff that banks will be charging and credit card companies. But researching and economic indicators like the gross domestic product and total index movements can help you predict a bull market. So, though I want to share a screen with individuals when we look at the markets over time, right? And one of the first ones I want to share is this one. Okay, this is the index performance, meaning the Nasdaq Composite, the S&P 500, and the Dow Jones. Those are the two market indexes that they sort of track. And there's way more than this, but these are the main ones. The Dow Jones is made up of stocks, I think international and American stocks.
30 stocks, yeah.
Say it again.
30 stocks, yeah.
30 stocks, right? But they're a mix of mostly American stocks, and don't they have some international stocks in there?
I thought they were all American, but
I think the 30 is all American, but the Dow Jones, it's another Dow Jones 100 or next. I forgot the next one up. Actually has both American, but the 30 is. I'm sorry, and you're right. Are a major blue chip American companies. Standard & Poor's, that's obviously 500, and then you got the
500
NASDAQ.
largest. Yeah, 500 largest.
The 500 largest, thank you, Dope. And the NASDAQ is mostly where a lot of the IT stocks are, by the way. But if you look at this chart from this year to date, starting from January to March, look, the performance indicators, and look like the NASDAQ is outperforming all the other market indexes, but they all are going up. And then have this chart I'd like to share with everybody. This is NASDAQ by each year this is from 1975 all the way up to 2024. I think it's December to 2023. It's the historical returns. And if look at the green, we're talking about bull markets. Look at the green, then look at the red. And that's why we always talk about being in the market over time now, because it's just like shorter periods of time. You can, like if you were in 2000, look, it was all red. In 2010 it went down, and in the early 70s it stayed down for a couple of years. But when you do and look at the long play, which we always talk about, this is what, and I think that average is 10%. But as you can see, look how it went. It seems like it's more than that. But this is in the last from 1975 to 2023. And this just tells you once again how the market, the return of the market.
Yeah, but that's almost 50 years. And if you look at a 10% average return, that means had you invested, $100 in 1975, and you go 50 years, that means you're averaging 10%. Your money would have doubled 7 times. Every 7 years it would double, and so in 50 years that's 7 doubles. That's some ungodly money. You do the math on 7 doubles. So you take that 100, so you go to 200 is 1 double, 400 is the next, 800 is the next, 1600, 3200, 6400, 128.
When you put it like that, though, good gracious.
It's again, but that's I get it because I'm a numbers geek. That's what I am. But that's not make believe. That is real money. Had you invested $100, that's how much you would have, in 50 years. That's what compounding does. the market, we're not saying it goes up 10% every year. We're saying the average return is a 10% average per year. So you got ups and downs in that period. And no guarantee it's going to continue to do that. But that's what it's done in the past. And there's no reason to think anything will be any different. So, yeah.
No, finish your thought.
Oh, no. I was just going to go to talk about how long the bull markets last, because that's probably what people are thinking.
Before you go to that, though, because I know some people probably think we like a parrot because we keep repeating this. But can you explain why we are so adamant, other than take away our personal investment tolerance? And a lot of people on here, some people like some of this information, Bob, is, it's overwhelming, it's too much. But we always come back, they say, to talking about the market. So can you give me just a short thing of why we're so adamant about being in the market, or should we, though?
Yeah, and it's because if you look at investing in savings accounts up until last year, they weren't paying any money. They weren't keeping up with inflation. But over the long term, we've talked about the S&P 500. If you go back to 1930s and go through today, it's averaged about between 9 and 10% per year. There have been up and downs. If you want to build wealth, that's one of the best ways to do it. It's not the only way. Yeah, you could buy lottery tickets and have a 1 in a gazillion chance of hitting the lottery. Or you could go on YouTube or invent something. But those things aren't for everybody. But this is something that everybody can do. Take a little bit of money every month, invest it into a good index fund that mirrors S&P 500, and basically you're probably going to average around 9 to 10% a year on your money. Some years you're going to make more, some years you're going to make less. But the average over the long haul is probably going to be somewhere between 9 and 10%. And as we always say, there's nothing, what we're telling you, there's nothing in it for us. I'm not looking to make any money. I'm not selling anything. I'm just telling you based on what I've done and the success I've had. And I'm trying to share with you guys how I did it. And it's so clear to me when you look at what the market has done in the past. And we talked about the rule of 72s. And all that is, if you want to know how long it takes your money to double, you divide your interest rate, you divide 72 by the interest rate. So in this case, divide 72 by that average 10%, and you get about 7 years is how long it takes your money to double. That's a fact. So you invest in the market, on average, your money's going to double every 7 years. You cannot get that type of return from anywhere else. There's some risk to it. If you invest at the wrong time, the market may go down. But we're talking about the long term. We're talking about building up over the long term. That's why we're so passionate about it.
And the rule of 72 works the other way too. Doe said if you said 10%, you divide it into 72, and it said it'll double in 7 years. It goes the other way. If you want to put something away you need it in 7 years, you put 7 and divide it into 72, and it'll come out 10. And it will tell you in order for it to double in 7 years, it'll take a 10% investment. So go both ways. But I just want to take a moment because I know we talk a lot about this, and I want to remind a lot of people, and I know they're going to say, well, you're an MBA. You're a CPA. Bob, you're an investment advisor. You work for the FDIC in finance. This is not, it doesn't take, you don't have to have a math degree. You don't have to went to school for finance for this. What we talking about, because the reason why I just brought it up and want you to address it, because I see so many studies that comes from Blacks, and don't get me wrong, I understand why we talk about the wealth gap, why we talk about only 40% of people own homes, why we talk about the number of black people that are not in the stock market, how, the income, but always hear the negative, what we're not doing, and I don't hear people telling what we need to do. And that's why I wanted to stop for a minute to just talk about this, you all. I'm sorry. So, Dope, let's get back to our topic, man.
Okay, well, let's talk about how long bull markets last. And this is on average. Again, this is all history. Every new bull market is going to be different. But on average, they last about 4 years. And since 1877, there have been 26 recorded bull runs, with some lasting as long as a decade. And the shortest bull run happened in 2008, right around that financial crisis. And there was a brief bull that lasted about a year, and then the economy took a crazy negative turn and growth slowed. But they've happened in the past. They're going to happen in the future. There's also going to be recessions in the future. But they happen a lot more than bad times happen.
And look at this chart, though, which gives, can you see that chart?
Yep.
Right. So explain like what you were just talking about over the amount of years, but look at the Dow Jones. This is 1915.
Yeah, this is going
today.
all the way back to 1915. The most important thing to get from this chart, is the slope. It's going up over the long haul. So it started off at 2,500 and it ended up at like 40,000. Okay. That's what the Dow Jones, that's what it has done in this time period. And so you see drops, and you can think about what happened that made these things drop, whether it was a war, whether it was economic crisis, whether it was political unrest, or it was a pandemic, or whatever. Those things caused the market to drop, but it continues to go up over the long haul. And that's what investing does for you. Over the long haul, it grows. So that's
remember
another reason why we're
whole period, remember through this whole period from 1915 all the way to 2024, within those lines, there were all kinds of disastrous events. World War I, World War II, the Korea War, Desert Storm,
Vietnam,
Vietnam, the New York, the 9/11. I mean,
yep.
And look, now let's don't even forget about our own personal events that happen within those lines. But did that stop anything? That's why we wanted to show this. That's exactly why we wanted to show this. So, okay, Dope. I'm gonna pick up next. So strategies for investing in the bull market, right? That's where we are, right? Yes. Yeah, I got off. You just talked about how long does the bull market last, though?
Yeah, you want to talk about the strategies, yeah.
Okay, thank you. The classic advice of buying low and selling high is never truer than during a bull market, right? But as an investor, this is a time to identify the opportunities and rebalance your portfolio if needed. Okay, that's the thing, According to the principles of dollar cost averaging, holding stocks through a bull market will result in more consistent and sustainable profits when compared to trying to time the market. We always thought you can't time the market. Dollar cost averaging helps you because you're purchasing stocks consistently, let's say monthly. Now, if one stock would be $10 a share, the next month it could be $15 a share. The month after that, it could be $5 a share. But when you do averaging, dollar cost averaging, it better positions you while you're holding stocks, and the results usually give you sustainable profits. Now, let me give you an example of what I'm talking about. Let's talk about Apple, right? Stock prices over time, to illustrate the benefit of buying and holding through a bull market. Now, a recent tech bull market occurred in the recovery period of COVID-19 pandemic between June 2021 through December of the same year, right? During this period, Apple stocks price rose from about $119 to $178 a share, representing an increase of almost 50%. While this bull market eventually ended, right? It ended and the prices fell. Prices of Apple stock averaged out over time, right? And so from September to 2023, Apple stock traded around $189. And it actually showed that the investors who panicked at the end of 2021, the bull market, and sold the shares, they did not experience this higher target price when it hit right there in 2023 in September, which was substantial, by the way. And instead of attempting to catch the top of the bull market, you can hold onto your shares and add more companies with solid fundamentals to your portfolio over time.
Okay, and this is one that I kind of understand, but it over the long haul, you won't get ahead. Some people like to have cash, and in some ways, there's nothing wrong with having cash. It's always tempting to do. It feels good to have cash because you have no market risk if all your money is in cash, but you also don't have a lot of growth potential, and inflation can destroy your purchasing power. If you look over the long haul, we always talked about stocks have done about 10% annually. If you go back 100 years, like that chart we just showed you, the average return rate is about 10% a year. Bonds and treasuries have done about 5.5% over that same time period. Gold has averaged 4.7% over that time period. But if you look at savings accounts, they're probably closer to 1%. And so you think you're getting ahead, but given inflation, you're actually going backwards if you are fully invested in cash. And me personally, I would never be 100% invested in stocks, and definitely wouldn't be 100% invested in cash. You have to find out where along that continuum you are comfortable. But to be 100% invested in cash, you're going to be going backwards over time because of inflation.
So when you say that, though, about not to be completely 100% in anything, that brings me to this topic of don't be too greedy either. Because 100% risk on every portfolio is a bad mistake for any investor. That's like saying I'm willing to lose everything, and that has never been a strategy, and it's actually been considered a greedy perspective. Meaning, make sure you have a plan. Don't just look at the money you making. That's how we get greedy. Make sure it fits your strategy. Now, be guided by your financial plan. That is the best bet in a bullish market. Your financial plan lays out how much you should allocate to equities, debt, commodities or liquid assets, right? Like cash and money markets. So stick to that and stick to that. And the moment your allocations go out of line, bring it back to the original. That's what I mean, being able to rebalance. Because if you got a lot of equities and the equities start, growing, it might throw your portfolio out of balance. Because now you might have had just 60% stocks, and because they've been making so much money, you might end up with 90% stocks in your, making up your total portfolio. So you need to look at that because you want to make sure it's well balanced, and that way you ensure you'll automatically book profits at richer valuations and have liquidity when cheaper options are available.
And the next one is don't be afraid to take a shot. And by that I mean, sometimes you can sit down and analyze numbers and look at charts and talk with a financial advisor who may give you a bunch of information to read about stocks. But sometimes stock buying is just common sense. It's example of looking around and seeing what's growing or what's becoming hot or what you think is a solid investment. And for example, this is one that had I take my own advice, I'd be almost as happy as I am with NVIDIA. But this was about 2 years ago. My daughter was asking me about my running shoes, and she said, "Have you looked at Hoka 1-1s? That's a hot new brand." I said, "No, I haven't looked at them, but I'll go look at them." So I went and looked at them, bought a pair, and they are wonderful. They're like limousines for your feet. I mean, they feel so good. And I talked to my son-in-law at the time. I said, "I think I'm going to look into this stock this company and consider buying the stock. Now, Hoka also sells boots. It's a company called Deckers. And this was 2 years ago. And at the time, they were selling for $260. That's what the stock was going for. The stock closed today at 906. And I could kick myself for not having bought it. I planned to buy it. I just didn't do it. But again, that didn't really take any financial analysis. That's just something you start looking around and saying, when I go to the gym, everybody's wearing Hokas. And you from personal experience, it's a great shoe. If anybody knows the name Peter Lynch, he used to run the mutual fund Magellan that outdid the market every single year he ran it. And a lot of it he did based on analysis. But again, some of it was just common sense. He bought Hanes stock because of his wife talking about how happy she was to be able to buy pantyhose at the checkout line at the grocery store. And this is years ago. But again, it's just another example of just seeing something before it happens or something that you feel is going to become big. Again, I'm not saying take the money that's going to pay for juniors' college education and do this. But if you have some discretionary money and you want to take a shot at a stock, consider something like that you have personal experience with, or you have some knowledge about, that you get a gut feel that you think it's going to do real good. There's nothing wrong with doing that.
Right. So dope. Let's get to this because people want to go and listen to the State of the Union speech that starts at 9 o'clock. But we want to get someone got a couple of more, so stick with us, you all. So protect your capital. Now, learn to cut losses quickly to preserve gains. Now, if you have a winning stock, you might want to add to that position so you can capture the maximum potential. That's called, momentum investing. You should always stay on the same side of momentum. So you can buy high and wait for the stock to go higher, or you can use dips to buy. Either way, you should never try to outguess the market, especially in the bull market. The very idea is selling against momentum can land you with big losses. So, think about that and consider it. Now, stocks keep hitting new highs. History suggests that might be possible. Since 1957, the Standard & Poor's 500 has hit 1,200 record highs. However, you should make sure you protect your gains.
Yeah, and there's always a risk of investing in a bull market. I mean, as things get high, there could be a sudden drop. I mean, it could happen tomorrow. It could happen next week. It could happen next month. So you can get overconfident and thinking it's going to go on forever. It's never going to go on forever. I don't care what kind of market you're in. It's going to drop at some point. You got to be prepared for that. Never invest money that you may need. As valuations continue to grow, things get too big, and sometimes they can drop. So just be aware. You could get another pandemic could come along, a war. You could have a supply chain issue. All kinds of things that could happen that could cause the market to go down. So don't expect, the market's not going to go up every day forever for the rest of your life. Be prepared for that.
So there's no scientific method to determine exactly when the next bull run will occur and in what sector. Now, even professional stock analysts may have trouble identifying a bull run until it has already reached the 20% that Doe talked about before, increase in valuation. Instead of timing the market, research solid companies that will add value to your portfolio and multiply in multiple economic climates. Now, the bottom line is a well-diversified portfolio constructed for your financial goals can prepare you to confidently stay the course and weather any kind of market, whether it's a bull or bear market. So with that, Dope, we're going to go to the summary and takeaways because people are probably getting ready to cut out. And we thank y'all for sticking with us, but we're bringing it home. And as you know, whenever we get on the summary and takeaways, that's the great part because we're going to be hitting.
Yeah, don't sit on cash. If you got cash and you get inflation, you're going backwards. You're not going forward. I'm not saying be 100% invested in stock, put some money in the market in a good mutual fund. It maybe mirrors the S&P or an ETF. Or again, if you got some discretionary money and you feel strongly about a stock, take a chance. But 100% cash, you won't build wealth that way.
And be a strategic investor. What do I mean by that? Don't be greedy. Have a plan. Always review and always adjust. That's what Dope always talk about. So you know where you are.
You can't time the market. Don't try. Professionals can't do it. Invest consistently and constantly, time for the long run.
And last but not least, invest in the market. And when you do that, the key is stay disciplined, think long term, rebalance regularly. What I mean by that, it's like I said before, you're in the stocks, you're in the equities, and with 60-40 in stocks and bonds, but the stocks increased up to 70 to 80% of your portfolio. You need to look at rebalancing to stick. If you want to stay at 60-40, then that's what you need to look at to rebalance regularly. That's what I mean by that. But it's very important, y'all. Me and Dope always talk about being in the stock market, and we wanted to talk today because the market has been really rolling, and a lot of people think they missed when they are highs like they are now. The stock market is as high as it's ever been in history, and people think they missed out. Let me give you an example, and I'll close out with this. Just when I thought I missed out on the video, when it went up to $500, I'm like, I ain't getting into that thing, and look at it today. So with that, you all, we want to thank everybody for being on. Roll call, hello to everybody. We're going to get y'all off of here because we know you want to see State of the Union, or you might just got something else you got to do. But we're here. This was our 140th show, Dope. That's pretty awesome, dude. So thank everybody for tuning in. Thank you, my sisters, all our friends. Now, oh, Tracy, what's up, you guys? Oh, what is that? Tracy's so funny. Tracy said, thank you, guys. Good stuff. No bull. So fun, Tracy. I love it, girl. All right, you all. Rodney, the Note, experience.com. Please check them out. And call. I know it's a lot of information, my brother, but we hope that we've been providing information that you can use, you all. So look, have a good evening, and we look forward to seeing you next week on the 14th. Have a good evening and a marvelous life.